6. Envision your success. Efficiency is doing things right. Effectiveness is doing the right things. Peter Drucker. In this chapter, you will envision your success by identifying and prioritizing business products and/or services based on profitability, as well as making sure that the business records are accurate. Therefore, an annual audit must be performed by a reputable CPA firm to enable you to protect your company from employee theft and to increase the accuracy of the business accounting records. The annual audit results are reported in a written audit opinion, and the language in the opinion defines an audit. An auditor reports on several topics including financial statements, regulatory requirements, and internal controls, because stakeholders including investors, creditors, and regulators rely on the accuracy of the financial statements. Rapid growth may cause an owner to lose control of operations, and business efficiency and profitability can decline. An audit reveals areas of company inefficiency and helps the owner to make improvements. It should be noted that there is a difference between a financial audit versus a forensic audit. The financial audit looks to determine your company's financial health for its current or potential investors and other stakeholders. The forensic audit is performed to provide support with litigation, and they can also conduct an internal control examination to identify potential opportunities for employees to manipulate current company controls, to misappropriate funds or assets from the company. As an entrepreneur, you will need to evaluate your business and decide what products are profitable, what products are not profitable, if any, and what products complement profitable products or services. Evaluate and decide to no longer offer products/services that are not profitable. It should be noted that most companies today struggle with identifying which of their offerings and which of their customers are the most profitable. They can measure revenue, but not the profit associated with the product or customer, which means they make decisions about what to sell, in which markets, to which consumers, and at what price, based on partial or inaccurate information. Methods used to allocate large buckets of costs, such as sales, advertising, and customer service, can be arbitrary and potentially inaccurate. Are some of the less profitable products and/or services complementary to the profitability of your business? Therefore, analyzing your overall business, evaluating where sales are coming from, who are your best and most profitable clients, talking to them, and soliciting their feedback is important for the growth of your business. As a business owner, you need to engage your clients in the conversation of the future of your company and show appreciation for their business. According to McKinley Advisors, it is important to understand and measure products and services against 3 metrics: profitability, stakeholder behavior, and perceived value and staff perceptions. And with that understanding in place, determining a clear path for future investment and product prioritization becomes straightforward. The most important metrics that a business owner must focus on are sales revenue, gross and net profit margin, and monthly recurring revenue. The best way to grow your sales revenue is to increase the number of sales by expanding your marketing, hiring new salespeople, or making special discount offers. Gross margins can be improved by making both your sales and production processes more efficient, and monitor your sales growth over various time periods. Monthly, yearly, and long-term metrics will give you a better understanding of where your company stands. Make it a goal to accelerate your sales growth every month, or at least keep it at the same percentage month after month. Evaluating the customer lifetime value of various client segments can help you understand which segments bring in a higher profit. Let go of clients who are decreasing your net profit and difficult to convert, and focus on the most rewarding clients and prospects. Having loyal customers is beneficial in many ways. It helps to grow your sales and spread the word about your products and/or services. and customer loyalty can be increased over time by providing excellent customer care and delivering high-quality products. Happy stakeholders and staff lead to long-term commitment and profitability. Business owners with a long-term and clear vision keep all stakeholders, including family and non-family members, motivated and involved in the growth and profitability of the business. In a Harvard Business Review article, Werner Reinhardt and Wolfgang Ulega write about how to sell services more profitably. When products become commodities, manufacturing companies may seek to differentiate themselves with value-added services, a potentially profitable strategy. Unfortunately, companies often stumble in the effort. Reinhardt and Ulaga conducted in-depth studies of 18 leading companies in a broad variety of product markets to learn what distinguished the successes from the rest. They discovered 4 steps to developing a profitable services capability. 1. Recognize that you already have a service company. You can identify and charge for simple services, as Merck did when it stopped quietly absorbing shipping costs. 2. Switching services from free to fee clarifies their value for managers as well as for customers. 3. Industrialize the back office. To prevent delivery costs from eating up service offering margins, build flexible service platforms, closely monitor process costs, and exploit new technologies that enable process innovations. The Swedish bearings manufacturer, SKF, provided off-site access to an online monitoring tool that could warn of potential failure in customers' machines. 4. Create a service-savvy sales force by focusing on customer satisfaction and the opportunities for new service offerings. Schneider Electric did a major overhaul of its sales organization and trained its people to switch from cost-plus pricing to value-based pricing. You may need to acquire new capabilities to take advantage of those opportunities. The industrial coatings specialist, PPG, had to learn how painting robots function after it offered to take over Fiat's Torino paint shop. Services can both lock in customers and help acquire new accounts. They should be developed with care and attention. In the book, Manage for Profit, Not for Market Share, A Guide to Greater Profits in Highly Contested Markets, the authors Herman Simon, Frank F. Blistein, and Frank Lubbe point out that the importance of challenging and changing your existing assumptions about your customers is the most important first step in identifying your hidden profit opportunities. It is always easier to retool by assuming what your customers want and are willing to pay versus retooling based on actual data. The authors explain the dangers inherent in using gut feeling, anecdotal evidence, and other corporate shortcuts to guide your decision-making, and use the links between price and profit to demonstrate the advantages of data-driven analysis. In the article Pricing Strategy and the Net, the authors Leland F. Pitt, Pierre Berthon, Richard T. Watson, and Michael Ewing write about marketing mix variables and how pricing directly affects a firm's revenue. The advent of a new medium for buyer-seller interaction, the internet, is changing the issue of price for both customers and suppliers in an unprecedented way. On one hand, there are internet dynamics that flatten the customer value pyramid, defined by the value of the customer to the firm, because of technology that facilitates customer search, customer control over transactions, provision of means by which the customer can make rather than take the price, a return to one-on-one negotiation, and commoditization of markets. Countervailing dynamics of the internet enable the firm, in some instances, to differentiate pricing all the time, to create customer switching barriers, to de-menu pricing, to differentiate on other dimensions of the purchase decision, and to reduce transaction costs. It is important to understand the internet-based pricing dynamics and price your products and/or services according to the relative strengths of buyer and seller. These dynamics suggest that pricing decisions can be as creative as those made about the development of new products and services, or advertising campaigns. According to this article, pricing may be indeed the last frontier for marketing creativity. During my research for this book, I also interviewed business owners who have fast-growing companies operating in an uncertain economic, political, and unstable countries with a weak currency. One of these entrepreneurs is Pablo C., a Harvard Business School OPM 32 graduate who owns an investment company in Argentina. Pablo is in the process of reconstructing his company to operate outside Argentina to provide more stability and profitability with hard currency revenues. Understanding what products and/or services are profitable is critical to the overall profitability of the company. Creating and managing a fast-growing company in an unstable environment is risky because the business owner can easily lose track of the finances. Brian Hamilton, chairman of financial information company SageWorks, says, "When your business is smaller, you probably have a pretty good command of your numbers. You can watch your cash and know quickly how expenses are stacking up to sales. But once you get to a certain sales range, it's hard to keep track of your financials in your head. You must keep track of your budget and understand your cash flow, which are key factors in managing a fast-growing business." Brian suggests consulting with your accountant more often than just during tax season, since cash flow mistakes are some of the main reasons why businesses fail. Also, overly optimistic growth projections or the failure to understand the difference between revenue, net profit, and actual cash on hand can mean trouble for your business. Fast-paced growth can be dangerous for your company if you do not go about it the right way. Do not lose track of your finances, and make sure that functions such as customer service, technology, and business operations are built to scale. For instance, an entrepreneur who has a small business in an unstable socioeconomic country may be better off selling his company. It should be noted that there would not be many opportunistic buyers in a country with a weak currency and unstable economy. However, the entrepreneur may want to engage his employees in the conversation of the future of the company and sell the company through the Employee Stock Ownership Plan, ESOP. Since most employees do not have enough cash to purchase company stock outright, the ESOP will give the employees permission to take out a commercial loan and purchase the stock. A commercial lender would likely approve the ESOP loan because the collateral on the loan would be the stock assets and goodwill of the company. The employees would then have to make monthly payments to the lender, just like with any other loan. If this is possible, it will enable the entrepreneur to sell his company at a competitive price and create an estate plan to distribute the money or make a trust to the benefit of his family. I have shared ideas about identifying and prioritizing your business products and services based on the profitability, including knowing when to sell a business that is no longer profitable due to government legislation and market conditions outside your control. Remember that according to Peter Drucker, efficiency is doing things right. Effectiveness is doing the right things.